Welcome to the Technical Analyst channel. In part 1, we introduced the basics of technical analysis. Today, we're diving into one of the core building blocks, candlestick patterns. The candlesticks represent the price movement of an asset. The green candle represents final price increase. And the red candle represents final price decrease, with the shadows acting as high and low prices recorded in the observed period. The period that the candle represents could be an hour, a day, or a week. Let's have a look at some examples of candlestick patterns. The Doji pattern is a sign of indecision between market participants. A doji forms when the opening and closing prices are the same or very close, creating a cross or a small body. This pattern signals indecision. In an uptrend, it suggests that buyers are losing control. In a downtrend, it hints that sellers might be exhausting. Think of it as a yellow light on the road, something's about to change. The hammer appears in a downtrend and has a long lower shadow with a small body at the top. It signals that buyers are stepping in, which could lead to a price reversal. Our last example for this video. The shooting star is a single candlestick pattern that signals a potential reversal in an uptrend, often seen as a sell signal. We have now gone through 3 examples of candlestick patterns. Like and subscribe for more. See you in the next video. Thank you for watching.